When the Federal Reserve changes interest rates, they do not change mortgage rates directly. They change a short-term rate, an overnight rate. And that tends to affect things like the 10-year Treasury bond, a long-term rate, but it's still government. That is used as a base to price mortgage security. And we're seeing a couple of weird things going on right now. There's been an effort by foreign countries holding bonds. They're looking for alternatives. And that may have helped push U.S. Treasury rates up just a little bit. But the thing that I find even more interesting is what's going on with mortgages, because there's been a historic spread where the 30-year mortgage was the 10-year Treasury plus about 160 basis points on average. But the spread is pretty wide now. Investment managers are saying, hey, interest rates are kind of high. Let's lock it in. And a Treasury bond locks it in. A mortgage doesn't lock in high interest rates, because when mortgage rates come down, everybody with a 7% mortgage is going to say, oh, is it time to refi? And those Wall Street investment managers are going to say, I bought a mortgage-backed security and it's paying me my principal back when interest rates are low. I don't want my principal back when interest rates are low. Today, there has to be a fairly large premium. But I think that's going to shrink a little. So I actually have mortgage rates coming down, maybe just 0.25% relative to treasuries, because I think that the investors will be less convinced we're going to get a big interest rate drop.